Look at a successful corporate balance sheet, and you'll spot a structural inefficiency. As operations generate profit, the cash balance swells beyond daily requirements. Leaving large reserves of cash sitting idle in a standard bank account degrades financial efficiency. Inflation erodes its purchasing power, and the capital produces zero return. To solve this, management deploys these surplus funds into financial instruments. They purchase shares in other companies, buy government bonds, or long-term fixed deposits. The objective is straightforward: put the capital to work. By acquiring these instruments, the company generates additional returns and maximizes utility. Tracking these deployed funds requires a distinct accounting framework. The ledger must map the transformation of cash into a recognizable asset, capture the ongoing yields, and eventually reconcile the final sale. Managing surplus cash constitutes an active deployment of economic resources. It shifts the company's financial profile and requires a specific, rigorous set of accounting rules. Consider how a business records standard outflows like rent or employee salaries. Those payments are classified as operating expenses. Operating expenses are consumed immediately to generate revenue for the current accounting period. Once paid, the value is gone, and the cost disappears from the balance sheet. This diagram illustrates the divergence. Cash flowing to rent dissolves into an expense, but cash used to purchase shares takes a different path. It transforms into an investment asset, firmly locking on to the statement of financial position. The company is simply swapping one asset for another. Because these financial instruments represent a present economic resource controlled by the entity and provide future economic benefits, accounting principles require them to be capitalized. The initial carrying cost of this new asset includes the purchase price, plus any directly attributable transaction costs like brokerage fees. This initial outlay acts as a preserved store of value. It is isolated from sunk operational costs, holding its place on the ledger until the asset is sold. Financial reporting divides these investments into two distinct categories: current and fixed. A common assumption is that the type of financial instrument automatically dictates its category, that ordinary shares are always one type and government bonds are always another. That is incorrect. Look at this bundle of corporate shares. The visual highlights a critical rule. Classification is driven strictly by management's intent and the expected holding period. Toggle the intent to short-term trading, and the shares drop into current assets. Toggle it to long-term strategy, and they move to non-current assets. Current investments are tools to optimize short-term liquidity. A company holds them explicitly to be sold or converted back into cash within 1 year or a single operating cycle. Fixed investments are held for the long term. Management intends to keep them to secure capital growth, generate regular passive income, or exert strategic influence over another entity. This chosen classification dictates exactly where the asset appears on the statement of financial position, which directly alters the company's reported liquidity ratios. Two identical blocks of shares can sit in completely different sections of a company's balance sheet. Strategic intent is the deciding factor in financial reporting. This circular diagram maps the complete investment account lifecycle. Accounting for these assets isn't a single journal entry, it's a continuous process, starting at the top, where available cash converts into a purchased investment. To record this purchase, the accountant debits the investment asset account to recognize the new resource and credits the cash account. Once held, the asset enters the yield phase, generating periodic financial returns as shown in Step 3. These returns typically take two forms: dividend income derived from equity shares, and interest income derived from debt instruments like bonds or fixed deposits. As these funds arrive, the company debits cash for the receipts and credits a specific investment income account. Crucially, these income flows do not alter the core carrying value of the investment asset itself. The yield is recorded as an entirely separate stream of earnings. The first half of the life cycle successfully locks surplus cash into a stable asset. At the same time, it creates a parallel stream of revenue that operates independently of the company's normal business activities. Eventually, management will liquidate the investment. The cycle reaches its final phases: selling the asset and recording the resulting outcome. At disposal, the accountant must compare the final cash sale proceeds against the original carrying cost of the investment. The double entry logic requires debiting cash for the proceeds received and crediting the investment asset account to remove the instrument from the books entirely. If the cash received is higher than the original carrying cost, the positive difference is credited to a recognized gain on disposal account. If the cash received is lower than the carrying cost, the negative difference is debited to a loss on disposal account. Disposal finalizes the asset's overall profitability. It closes the accounting loop by returning the transformed capital back into raw cash, ready to be deployed again. These ledger entries flow into macro-level reporting. Here is a statement of financial position and an income statement. A glowing pathway maps the investment balance as an asset. Secondary pathways route the periodic yields directly into the income statement's revenue. Any realized gain or loss calculated during disposal also flows directly into the income statement, impacting the company's net profit for the year. A single investment lifecycle radiates across the entire reporting structure. It simultaneously dictates the company's documented financial position and its measured financial performance. These actions are governed by a broader regulatory framework, the Malaysian Financial Reporting Standards, or MFRS. MFRS dictates this rigorous lifecycle to ensure all financial assets are recognized, measured, and disclosed uniformly. This standardization prevents companies from manipulating their asset values or misclassifying their returns. Strict adherence to these rules provides auditors and stakeholders with verifiable proof regarding the existence, ownership, and valuation of the company's economic resources. This mastery of the investment ledger provides the essential professional translation of strategic capital allocation